The Full Circle Podcast. Compelling interviews and incredible tales from Colorado's western slope, from the mountains to the desert. Christi, Reece, and her team hear from the movers, shakers, and characters of the Grand Valley and surrounding mountain towns that make the western slope the place we all love. You'll learn, you'll laugh, you'll love with The Full Circle.
Spencer, thanks for being here. Quick question to start you off. How long have you been in the lending space and what got you into it?
Yeah, absolutely. Great to be here, Ian. About 24, going on 25 years now. Got in with some friends, actually talked me into it, and it's been, a great ride ever since. So yeah, that's it just has flown by. So I didn't necessarily aspire to be a mortgage loan originator, but it happened, and I joined a good group, and it was a lot of fun, and it is still fun. So yeah.
Awesome. Well, we're going to dive into some questions to really kind of understand what you as a lender do and what your industry kind of does for the world of real estate. So when looking at what a lender really actually does versus what people may assume, most people may think of a lender as somebody who just hands over the money, but the reality is closer to kind of like a project manager or who orchestrates underwriting and appraisal and title and insurance. So tell us a little bit, what's the biggest misconception that buyers have about pre-approval versus pre-qualified, and why that difference actually matters?
Yeah, that's a good question. I almost wished that pre-qualification really wasn't used in any sort of mortgage terms. A pre-qualification is where we usually just have the initial phone call or conversation with a potential buyer, and it's just a very basic rundown of what they may qualify for or approve for, looking at their budgets. We usually pull a soft credit pull. We don't view or review income documentation, asset documentation. It's just that first initial welcome phone call kind of a thing to learn about their goals. So a pre-qualification definitely shouldn't ever be used to get somebody to go out, meet with a realtor, and start looking at homes, for sure. A pre-approval, on the other hand, though, is where an originator should, at that point, gather up all the documentation that they can, all the income documentation, all the asset documentation, review, do a hard credit pull, and make sure that individual qualifies for the particular loan that they're looking for. A pre-approval is what we give to an individual to go out with their realtor and make an offer on a home. So as a realtor, hopefully they look for something that says pre-approval, not pre-qualification. Hopefully a buyer goes out understanding that they've given that documentation and it's been scrutinized by a licensed loan originator. So those are the two main differences, and they are big differences. Yeah,
I get the idea for what it is basically so that somebody doesn't get their hopes up, or a seller doesn't get excited about somebody coming to view their home, and in turn it turns out they actually won't ever be able to afford that home right now, or it's not something that's in their budget to even start with, and so then that's somebody who's looked at the home that's not even going to be able to put an offer on the table.
It's a huge disservice to the buyer. It's a huge disservice to the seller. Buyers run the risk of losing their earnest money. Yeah, it's a bad deal. It's a bad deal.
So going down in that a little bit further, so when we talk about loans and the ability to actually then go look at homes, where do you find that most loans start to run into trouble? And how do you try to prevent that before it becomes a problem at the closing table?
Well, luckily most loans don't run into trouble. If they did, I think we would all not be in this business. But where buyers can get tripped up is if their loan originator doesn't perform a proper pre-approval, doesn't scrutinize that documentation and really have an understanding of the particular loan program guidelines. For one, there are things that can happen during the process that are unforeseen, things that pop up on a property issue. But generally speaking, the way you get in front of any potential issue that could pop up is being ahead of the game. So loans go through several steps. You had mentioned that earlier, where a loan originator is much like a project manager. We're managing each step of that process from the beginning pre-approval to the closing table, right? And there's many steps in between there, and we're managing that. Getting those steps out of the way early on and catching potential problems, that's the best way to do it. In a nutshell, that is how we can catch things, and it's much easier to find things early and tell a buyer and a seller that this can't work out really early in the process than the day before closing, right?
Right. So some may know this or some may not, but there's obviously 3 different, I guess, popular types of ways you can acquire a mortgage: through a mortgage broker, a banker, or a credit union. And so I kind of want to talk about picking one of those and why one may be more better for your situation, why one may work better for your situation than another. So I think oftentimes buyers pick a lender based on a name they recognize or a rate that they saw advertised, without really realizing that there's options that operate completely differently. So when a buyer is shopping for lenders, what should they actually be comparing beyond just the rate that they see advertised?
Yeah, there are a couple of things that I would tell a buyer to review and compare, just in addition to the interest rate, and that would be looking at fees. A lot of times somebody might see an online advertisement for an interest rate that's lower than the going market rate, and only to find out later that later in the process that there are a lot of fees being charged. So comparing rate, for sure, absolutely, but comparing fees associated with that rate. And then also, a lot of people are doing this lately, which is great to see. It wasn't always this way, but customer service. You really need to compare what type of communication are you getting? How do you feel when you interview these lenders? It's much like an individual interviewing real estate agents. You have to be comfortable with them. You have to see what kind of customer service they offer. Do they answer the phone when you call them? Do they respond to your emails or your texts? So customer service, fees, interest rates for sure. As it pertains to products, generally speaking, most competitive, relevant lenders in today's day and age have pretty much the same product. So you're not going to really find too many different products between lenders. For sure, there are some. That's true. But really, it's more so now, how do we differentiate ourselves from each other? And that's usually customer service, rates, and fees.
So PRMI, or Primary Residential Mortgage Incorporated, is a mortgage banker. Is that correct?
Right.
So how does that compare to a traditional bank or a credit union? And what does it mean for the buyer's experience? How does that differ?
As it pertains to the mortgage loan originator, such as myself, our duty between a mortgage bank, a mortgage broker, and what I call a depository institution, a bank or a credit union, our duties are the same across the board. So a buyer isn't going to necessarily get a different experience from the individual LO, a good individual LO, in any of those entities that you just mentioned. As a licensed individual, it is our duty and obligation to act in the best interest of the buyer, right? We're the licensed individual. And so that licensed individual is supposed to act and conduct themselves in a way, a way that is beneficial to their buyer, right? Whether they work as a mortgage banker, a mortgage broker, or a depository institution. The differences, I would say, for example, a depository institution like a bank or a credit union, such as, say, U.S. Bank or Bank of America, when you walk into one of those places, a branch of one of those, you'll see, you can go to the teller and manage your checking and savings account. You can go over here and get a car loan. Mm-hmm. You can go over here and get a mortgage loan. These are depository institutions that happen to do mortgages. Whereas a mortgage banker, such as myself, and a mortgage broker, that's all we do. We only do mortgages, and we better be good at it,
Right.
or we could go out of business. Whereas a depository institution, they make money in many ways. I'm not saying that you might get a bad mortgage from them. That's not true at all. They can do a very good job at it. However, with a banker and a broker, a mortgage banker and a broker, we have to be good at it.
That is the business that you work in.
That's all we do.
So let's talk about an agent-lender relationship. You hear a lot of times your first step, and it can flip or flop, but your first steps, meet with an agent, and then they'll get you connected with a lender, or meet with a lender who will then partner you with an agent.
Sure.
And because those two steps fall pretty closely right in line with each other, you got to have one to kind of start with the other. So why does it matter to a buyer whether their agent and a lender have a great relationship? And what can a local lender like yourself do that an out-of-state lender or online lender can't?
I would say look at it like this. From a buyer's perspective, you walk into a building. You're on the first floor, and on the second floor is the closing room, the closing table. And the goal of buying a home is always to get to the closing table, because that's where the keys are. They're going to give you the keys to your house. You want to get to that. You've got your team there on the first floor, the buyer, the lender, and the agent. The buyer always gets to take the elevator. They get to step in the elevator, push number 2, start climbing up. Well, the lender and the realtor, we got to take the stairs. Each one of those stairs that we climb is a step in the process, and we do it together. The agent and the lender should do it together, and communicate as we go up the stairs, right? The buyer knows that we're in the stairwell. They don't see the stairs, but they know we're climbing. They know that we've got to get up there, but they don't know how many stairs there are, and they don't know the condition with which the stairs are. All they know is that they're supposed to walk out of that elevator, step out of the elevator, and we're supposed to step out of the stairwell, and all three of us walk into that closing room together. The sky opens up, champagne and confetti fall from the heavens, and everybody lives happily ever after. And that is how almost every purchase transaction goes. But that the teamwork of the agent and the lender climbing those stairs, going through those steps from appraisal to title to processing to underwriting, I think is it's definitely, I don't know if it's a lost art, but if it is not the priority of an agent and the lender to work in conjunction to get to that closing table, that room with the keys, they're really missing out, and the buyer's really missing out in that teamwork. So the relationship should be one of open communication. The agent should be able to call their lender and say, "Hey, I need you to come out to the house with me and take a look at this and see if it'll go with a government loan or not." That kind of answers your second question. What can an online lender not do that a local lender can? Well, the online lender can't be here, can't meet with the buyer in person to person, can't shake hands, can't meet on an emergency meeting with an agent and say, okay, how do we get over this particular hurdle, something unforeseen? Right. That's why working as a team, communicating as a team, and meeting as a team to get to that finish line, that closing table, that's the difference between a successful closing and one that's rocky that may not even close.
And the difference between a surface level relationship and a personal relationship. I mean, I think it's fair to say that a lot of times you become so communicative with your lender and your agent that they are just then a part of that story. And if that relationship's not there, it doesn't do much for that experience. Or the next experience that you have going forward. Right.
Yeah, I've heard horror stories where a first-time home buyer had such a bad experience that they wished they'd never had bought a home ever, and they certainly at that moment don't want to ever buy another home again, which is really tragic.
Right. Yeah, and it hurts the relationship and the job that the lender and the agent go through to get the buyer to the closing table.
Yeah. Oh, yeah. Absolutely.
So now let's kind of dig into various loan programs. And so most buyers know about kind of the big four: conventional, FHA, VA, USDA. in vague terms. But let's kind of dig into what all those are for, who they're maybe more specific to, and then some of those lesser known programs or local incentive programs or opportunities that may not be so advertised. So let's start with conventional FHA, VA, and USDA. Can you break down which one each of those is really designed for, and then how you see them get used most?
Well, I would say the conventional FHA and USDA loans can be for multiple different types of buyers. Really, the only specialty one is the VA, where it in some instances can be a spouse, but it typically always is designed for a veteran or active duty, but somebody in the military, right? So the other ones can be used for first-time home buyers. They can be used for repeat buyers. If you were to put a few points of interest on that, FHA a lot of times will typically be a little more lenient on credit scores. They'll typically be a little more lenient on a person's debt to income ratios, for example. So you may have a little bit better buying power. The USDA is a great tool for somebody who doesn't have a down payment. However, they're a little more strict on debt to income, and they have to be in a rural area. So it's not that they are necessarily black and white. You have to fall within this box. That's not really the case. It's just a matter of speaking with a local qualified lender that can go through. You qualify for all of these options. Which one seems to suit your goals, right? So really only the VA loan is really guided towards a particular individual. The other ones can be used for multiple different types of folks. Okay.
And so for, let's say just with my experience, there's certain homes that will go FHA versus conventional, or vice versa. They won't go FHA, so you have to go conventional.
The condition of the property, yeah.
Right. I would say speak to that and kind of what determines whether it can be FHA eligible or not.
FHA comes out and says, hey, we can be concerned for anything that is health and safety related with the condition of a home. So conventional is a little more lenient on that. USDA usually follows the same guidelines as FHA. So if a home certainly if a home is in disrepair, it probably won't go FHA or USDA. And depending on how bad of a disrepair it is, it may not even go conventional. It could be cash only, right? So generally speaking, VA, USDA, the government agencies, Ginnie Mae is who controls FHA, VA, and USDA. That agency has a specific set of guidelines for the condition of the property. If the home is pretty rough, it may not go with those government style loans. Conventional is a little more lenient. Yep. And this is where we, as lenders, we rely on the agent to kind of know a little bit about that. We certainly don't expect a real estate agent to know all the ins and outs of the mortgage guidelines. Mm-hmm. However, if they're getting ready to list a property, it is appropriate for an agent to know, can I accept an offer from a buyer that is bringing an FHA loan? So right. Going back to the relationship with an agent and their lender, that's super important to be able to call us up and say, hey, come take a look at this house. FHA is really particular with peeling paint, for example. If there's peeling paint on the soffit, and we can go out and help and take a look at it and say, this should go FHA. We'll be okay. Mm-hmm. Or we look at it and say, it's got 2 layers of shingles. FHA is not cool with that. Mm-hmm. We can say that. So yeah, for sure. A buyer can be very confused about why they can't make an offer on a home depending on the condition of it. And so, right. Yeah, setting those expectations and managing that early on really can help the buyer's experience as they go. Because they'll fall in love with a home only to not be able to make an offer on it because they didn't realize, my loan doesn't work for that.
You're right.
Yeah.
And, a lot of times, too, I think at least from what we can experience, or have experienced, the sellers will then take that advice from the lender or their agent that says, hey, this home is not FHA, eligible, and maybe take the time to do those repairs ahead of time versus waiting for an offer that says, hey, we actually want the, house repainted or the, soffit to be fixed or whatever it may be. And so they can do those repairs out in advance instead of waiting for an offer that maybe requires that, or they can't submit an offer because of those various things, right?
Well, yeah, absolutely. Look at it this way. If a seller can and has the means to offer their home to a bigger pool of buyers with more lending options versus cash only,
right.
You know, if I have a home that I can take all of these loans, or I've got a home that can only take people with cash, I mean, right?
Right. Yeah, totally. So let's talk about some of the local and state down payment assistance programs that are available. So let's talk Mesa County specifically. Let's break down or kind of go through some local and state down payment assistance programs that you're familiar with and that are available right now for most buyers who maybe don't even know that those exist.
Yeah. No, that's a great question, and there are a couple for sure. Colorado, as a state, has a couple. Obviously you would have heard of CHAFA, and CHAC is another one, and these are down payment assistance programs offered by the state, so it doesn't have to be just Mesa County. These can be in the entire state of Colorado, and those are the most popular, primarily because, well, they're the biggest, and they are they always have funds. They are a lender, so they have funds available to offer to buyers. Mm-hmm. The city offerings, or the more local down payment assistance programs, for example, Housing Resources has one here in Mesa County. The local Grand Junction Real Estate Association has some money to give towards closing costs. Those are based off of a budget that they have, and sometimes they have money and sometimes they don't. So it's a matter of, again, working with your lender to find out if those funds are available, which then means that CHAFA, CHAC, for example, they're the ones that are used mostly by individuals that need help with the down payment assistance. And they're not just for down payment assistance, though. They have other redeeming qualities, not just for down payment assistance. But those are the primary ones that we use and seem to be the ones that serve the buyers the best. Mm-hmm.
And are there any profession-based programs that you're familiar with that are available, you know, for teachers, first responders, healthcare workers, stuff like that?
Yeah. Each lender has a different style of loan for those professionals. Some call it Homes for Heroes. Some work special deals with veterans. So you really just need to call your local lender and find out. But yes, to answer your question, there are programs out there. There are doctor loans that help somebody just getting out of medical school and they haven't even started their career yet. They've been offered a job, but they haven't started there yet. There are loans for them. Mm-hmm. The government has some loans. They're far and few between these days. It used to be very prevalent, called the Good Neighbor Next Door, where specific homes in certain areas of a town would be offered to a professional, a first responder, teacher, a police officer, et cetera, that would give them a discount on the price of the home. So yeah, there are programs out there. They all have their pros and cons. Definitely speak with your local lender to go over what those are and what they entail. Mm-hmm. Yeah.
So let's kind of myth bust some misconceptions or, you know, fear-based hesitations that are maybe popular or that you run into quite a bit. So I think the common one that you know, a lot of people find themselves saying is, I need 20% down to buy a house. What is your, you know, what do you have to say to that, or what would you tell someone who comes to you and says, I don't have 20%?
Well, I mean, right off the bat, I would say you don't need 20%. Disagree. You don't need it. If that's the misconception that's out there that people are learning or hearing or regurgitating one to another, no, you don't need it. There are so many there are so many programs out there with as little as 0 down to 3% to 5% to 10%, 15%. many options. So yeah, I've heard that misconception before, and it's unfortunate, but you definitely do not need 20%.
Let's say our next one is my credit score is not good enough. So what scores actually qualify for what programs, and what's the floor?
Man, I hear that one all the time. That's a good one. It is interesting that the online, like the free credit reporting companies that are online that help a person monitor their credit, they are good. They're actually really good, and I admonish individuals to sign up with one of those. But it is very interesting that that model and that score that's being pulled is not as accurate as what a true score is. And so a lot of times people will look at that free credit reporting agency score and say, well, I can't get a loan. I've Googled what it takes to get into this particular loan, and my score is not good enough. No, maybe you need to call your local lender and find out if your score is not good enough, because there are programs where you don't even need a credit score. There are programs that are into the low 500s depending on the situation. Credit scores go somewhere between high 3s to mid 800s, right? Which is quite a spread.
Right.
There are programs that go down into the 500s. There are programs that you don't even need a credit score. There's only one that I know of. But the point is, don't just go off of what you see your score on your credit card bill and then say, oh, I can't buy a home. I've resolved myself to the fact that I'm going to rent forever.
So a lot of times people will say rate shopping hurts your credit. Talk about like the 14 to 45 day window for mortgage inquiries and how that works. So
if you have a couple of different mortgage lenders pull your credit through it within 45 days, it's through the FICO scoring system, which is what we're using right now. Advantage is a credit scoring system that's becoming more and more popular. They're a little different. I think they're more like the 15 days. But if you have your credit checked multiple times within those 45 days, it only counts as one inquiry against you. But also, a hard mortgage hit does not negatively affect your credit score like a credit card hit does. So again, telling people, look, don't worry so much about that. If you are worried about it, have the lender do a soft credit pull. But make sure that you're talking to a lender and looking at your options, whether it be through a soft credit pull to start and then a hard credit pull to then start shopping interest rates. Is totally appropriate. It's not very common for a buyer to have more than 2 or 3 of us pull their credit. It really isn't. By that time, they've found somebody that they gel with. Right. They've got good fees. They've got a competitive interest rate, and they usually stick with them. So it's not really common to go much more than that. Therefore, don't sweat it.
Right. Let's say another one is, I've inquired a lot of debt, whether student loans, car payment, whatever it may be. So I need to pay off that debt before I'm able to buy. Talk about how debt to income is actually calculated and why paying off all your debt before buying could actually backfire on you.
Well, I would never tell anybody not to pay off their debt, right? However, some folks will get it in their mind that they have to have it all paid off, and fast forward years later, they don't have it paid off and they're still renting, throwing their money away. And that, again, is another tragedy. So get with an intelligent, smart, qualified local lender and actually go through your accounts and see which ones they recommend that you pay off. To your point, if you pay off too much and you don't have any debt anymore, your scores start to go away. So you're right. You do want to have some payment history for the credit scoring program. So what I recommend is, again, getting with your local lender and saying, these are the debts. A, do I need to pay any of them off? You may be surprised. You may not need to pay any of them off. Your debt to income ratios, which I'll answer that question here in just a second, but you may not need to pay anything off. B, your lender can go through them and say, okay, pay these off, and it may boost your score and get you into the next better interest rate bracket. Or it may approve you for the next loan program. Maybe you approve for one program, but if your score goes up another 20 points by paying off this loan, your score may go up higher, and now you approve for two options. Get with your lender, go over that. Don't be afraid to have your credit pulled, and go through a budgeting process and a process with which to figure out what loans you should pay off. The way we look at debt to income ratios is we take into consideration all of the payments that are on your credit report plus the house payment. We don't take into consideration what you pay for groceries, typically, what you pay in fuel or insurance, typically. So we want to talk to you about that and make sure that we put you into a program, taking all that into consideration, advise of a program that meets your budget, right? But that debt to income ratio is all of your outgoing payments versus the income that we can use to qualify. And that ratio, depending on what program you're trying to get into, or a program that we recommend, has certain guidelines, and we need to fall within those guidelines of debt versus income.
And is there a standard, ratio of debt to income that you guys look for or try to fall between in order to make that advice?
Well, there's two things that dictate that. Number one, it's, as a fiduciary, we want to make sure that somebody isn't house poor. So, yeah, if you Google it, I think they say you really don't want to be over 42, 43% debts versus your income, right? Your income going to the debts. However, there could be some other circumstances that would allow you to be comfortable going above that. So we want to look at all of that. Number one, so yes, we always recommend that they get something that that not only can they afford on paper, but they can feel comfortable and take that weekend vacation and not be house poor.
Right.
So we look at all of that, and we try our best. Usually, a buyer will come back and say, "Well, the home that I really love is about $20,000 more than I thought, and the payment's going to go up a touch, and I'm just outside of that. Do I still qualify?" Yeah, you do. On paper, you do, absolutely. Are you comfortable with that?
Right.
How can we help you with your budget on that? And that's what we try to do. So yeah, it's super important, definitely. And they're really only black and white ratios you get into where you really can't even get a loan is when you exceed a certain amount of your income, where 50 to 60% of it's going towards the house payment and the new house payment and all your other debts. That starts to get rough for most loan programs. Right. There are some programs that don't look at it as tight as others, such as VA, for example, but FHA, conventional, USDA, some of them can get pretty strict on that threshold.
And let's talk a little bit about paying down points on your loan versus saving that money and waiting to refinance later. That's a conversation that has come up, I think, maybe more frequently now that interest rates are a little higher. And I say higher for people that were bought in COVID and have 3% interest rates. But talk to the point of when does it make sense to buy down a rate or to pay down rates or pay towards points for your rate versus just holding off and refinancing later?
There isn't any black and white answer to that. And if a loan officer tells you that there is, this is a hard fast, you should buy down this interest rate, you should do a temporary buy down or a permanent buy down, I would caution you to maybe get a second opinion. And what I mean by that is this: it depends, is my answer to you. How long are you going to be in the property? Is it a short-term stepping stone type of a property? Could you potentially be transferred with your job? You may not want to spend all of your money out of pocket to buy the interest rate down if you don't think if you're not going to have that loan very long. If the rates do come down, and that's a big if, they've been meaning to come down for the last 2.5, 3 years, and they haven't. So hindsight is always 20/20, right? But they're based off of all of those questions, all of those particular scenarios. My counsel to my buyers is let's take all of that data, all of the answers to those questions. Let's see what we can buy it down to, how much that costs, and how much does that save you monthly, not only on your monthly payment, but also on the compound interest over 5 years, over 7 years. Does it make sense?
Right.
And sometimes they will say, you know what, I would just rather keep that $5,000 to $7,000 in my pocket for a rainy day. Or, this is my forever home, I'm not leaving. I don't expect the rates to ever come down in my lifetime. Maybe they're of an age where it doesn't make sense, and they don't buy it down at all. So there isn't a hard and fast, you should do this. It just depends. And again, it's difficult to do that over the phone or over email with a online lender.
Right.
Yeah.
My last kind of final thing for you here is if you could put one sentence on a billboard for every first-time buyer in this market, what would it say?
Don't give up. Don't give up the dream of homeownership. It may seem daunting. You'd have to look it up, but I think it's accurate. I think the lowest percentage of home buyers right now are the young millennials and the Gen Zs. They are the lowest percentage of individuals buying homes. It could be for many reasons, but I suspect some of those reasons might be the fear of the interest rate, the fear of the monthly payment, and the fear of the home prices increasing. Don't give up. Our industry changes so fast. What was not available 6 months ago might be available now. Interest rates change daily, up and down. Homes come on the market daily. What wasn't there yesterday, the home that could be your dream home, or could at least check most of the boxes, could be there today. Don't give up. Keep working with a savvy lender and a savvy local realtor, of course. Make sure you have that team that can climb those stairs for you. Meet you at that closing table, with the champagne and the confetti. But don't give up. Don't give up that dream of home ownership, because it'll happen.
I think the idea too is that, even if home ownership is not, in the cards for you next weekend or next month or 3 months from now,
100%.
Establishing that relationship with
Yes.
the lender and the agent so that they know what your situation is, they know where you want to go, they know what you want to do, how you want to end up.
Yeah.
So that when the market changes and when that house that wasn't there yesterday or last week comes on the market, they can say, hey, I've been working with you. We've got, there's a house available now. It suits your budget. Let's get back in touch with that lender. Let's do let's go through the steps. And what you thought was going to take 2 years is now going to happen within the next couple months, and you're under contract.
But I've had first-time home buyers, several, that it's taken 2 years. It's taken 2 years for them to settle on a location, a price, an interest rate. They did need to do some credit repair. They did need to pay off a few things. They did need to get in a better position financially with their income. So, yeah, it may take 2 years, and that's okay. But just don't give up. It will happen. And like you just said, the timing may not be right today, but it could very well be right tomorrow. Yeah.
Well, Spencer, thank you for your time, your knowledge and expertise on this topic. If audience and clients and whatnot want to reach out to you and either learn more or have questions for you, how can they get in touch with you? And
absolutely, no, they can reach me. I'm on the web. My cell phone, 970-270-4086. Call me, text me anytime. If I can't get back to you right then, or if I can't answer your phone call right then, I'll get back with you really quick. So yeah, feel free to, that's what I do.
Awesome. Well, thank you for your time. If you also have any questions as well, you can always reach out to the Christi Reece Group and get with an agent who can also pair you with Spencer or another local lender like we've mentioned. So give us a call, 970-589-7700. Spencer, thank you for your time.
Yeah, absolutely. It was a pleasure.
Thanks for listening. This is Christi Reece signing out from the Full Circle Podcast.